Welcome to Market Call. I'm Marella Fernandez. Dan Wong on the show with us today. He's portfolio manager at Scotia Wealth Management. He's taking your questions on North American large caps and ETFs. Here's how to reach us. Call toll free at 1-855-326-6266. Of course, you can email your questions as well. Market Call at bnnbloomberg.ca. Stan, good to see you. Thanks for coming in.
It's great to be here. Thank you.
Let's talk about the job numbers out this morning. So about a 41,000 loss of jobs for July, reversing some of the gain, about half of the gain we had in June. What's your top line read on this?
Well, unemployment rate remains the same, but it's not really too surprising as we are expecting a little bit of softness in the Canadian economy in the middle two quarters of the year. So really not something that was unexpected in my opinion. I think that the jobs market will continue to be a bit choppy, especially with regards to whether or not it's part-time or full-time and so forth. So I think that with the Canadian economy, we're going to see a bit of softening in the middle two quarters of the year.
But not manufacturing hit. Manufacturing actually gained. So that was a little bit surprising to me.
It is, and I think it's just the ebbs and flows of the economy. And then, of course, you've got the tariff issue that's at hand at this point. So generally speaking, we're very selective on the Canadian market, and we're somewhat cautious as well.
Got it. Let's talk about earnings report. We had lots of them come out the past couple of weeks. How would you characterize, if there was a theme from this, what would it be?
Well, when you look at the U.S. market, I mean, we're seeing about 8.5%, 9% second quarter year-over-year growth in earnings growth, which is more than expected as well. So I think that's good news. And of course, technology continues to lead. We're seeing great earnings reports from Microsoft and NVIDIA and Alphabet over the last month or so. And I think about 81 or 82% of companies so far this quarter in the U.S. have beaten earnings expectations. So resilience would be the word that I would use right now.
Okay, so what sectors are you backing? You just spoke a little bit about tech. Obviously, we know it's on a tear. Are there other sectors you're backing at this point? Yeah,
I think that technology makes sense and financials would make a lot of sense in this environment. We do like industrials. Some of the industrial names have been really doing well, right at the top of the 11 sectors so far this year in terms of performance. Healthcare, you got to be selective. As you've seen, some names have gotten beaten up a little bit, but some names have held up quite well. But it's a very, very diverse sort of sector, many different industries in that healthcare sector. So those are the 3 or 4 sectors that I particularly like.
Are you looking at tariffs when you are looking at sectors? I ask because Donald Trump has grand plans for pharmaceuticals in the U.S., semiconductors, 100% tariff. Are you still sort of trying to factor that in, or is it less of a weight on some of these sectors?
I just think it's very challenging because news that comes out one day about tariffs can change the next day. So we go back to our quantitative methods and look at the formulas that are at hand and look at what earnings we expect based on the numbers that and data that we have at hand.
Got it. All right. Stan Wong sticking around to take your questions. He's with Scotia Wealth Management. Your question today on North American large caps and ETFs. Here's how to reach us, phone number and an email. We're back in a moment. Stay tuned. We're going to start with an email right now from Dallas, who says, what does your guest think about XUTI shares, S&P TSX, Cap Utilities Index, ETF, as an income source, net of share price risk?
Sure. Thanks for the question. So obviously, this is a utility index holding about 15 names, including Fortis, Emera, and Hydro One. Obviously, a very defensive type of approach with about a 3.9% dividend yield, low beta exposure. You're probably getting half the beta relative to the TSX. And it's really ideal for income-focused type of investors looking for that 3.9% dividend yield. With that being said, if you look sort of long term, if we see interest rates eventually start moving higher, although we don't see that in the near term, it is interest rate sensitive. So if rates go up, valuations will come down and pricing will come down on this one. And then the risks for some of these utilities is regulatory decisions and CapEx overruns can trigger some downside to some of these names. Generally speaking, it's not an area that I really like. Utilities, not a sector that we're really holding right now. If you look at this ETF, it has underperformed the TSX, the broader market, over the last 5 years. Total return 38% for XUT versus 95% for the TSX. Again, if you're looking for income and more stability, XUT is not a bad place to be.
Got it. All right, let's go to the phone lines. Chris on the line from Victoria, BC. Hi, Chris.
Hi again, Marella, and hello, Stan. Stan, I believe you have been a fan of LVMH in shows past, and I'm wondering, because the price is quite depressed now, if you see it as good value, or if perhaps something like and I'm going to pronounce it wrong, an Hermes is a better buy. I do own both. Thanks very much for your insight.
I am no expert in the luxury lines, but Hermes, I believe, is how you pronounce it. Is that correct?
Hermes, yes.
Okay. So what do you think about the luxury area right now? We know consumers have been a little bit reluctant to part with what's in the wallet.
So LVMH is a name that we held before, but we sold a while ago, just simply mainly because the rebound in the Chinese market really wasn't there after COVID. So we exited that name. Hermes has performed a little bit better. You can tell that from the 200-day moving average, still trending slightly higher, but still flat. But LVMH continues to suffer. What we've seen is some of the slightly lower tier names like a Tapestry has done better. And I just think that the macro environment is leading to this right now whereby consumers are very, very choosy as to what they own. So LVMH has kind of gotten beaten up. You might have remembered that Gucci had some bad news about a week or two ago as well. So very, very selective in this space. Hermes seems to be performing a bit better, but I think the luxury space is an area that, given the fact that we're probably mid-cycle at this point, is probably not an area that we're really attracted to right now, unless the valuations get so cheap that you have to be attracted. But right now, I don't think we're there.
Got it. So you wouldn't invest necessarily right now in either?
Not in those names, no.
Got it. Okay, let's go back to the phone lines. Doug is on the line from London, Ontario. Hi, Doug.
Hi. Afternoon. Stan, I was wondering your thoughts on Pembina Pipeline. It reported, and they're quite depressed right now, and I want to think this is a buying opportunity. All the other pipelines today seem to be up, and Pembina is going the opposite way. Just like your thoughts. Thank you.
Okay, so let's talk about Pembina. We get a lot of calls about Pembina. People are definitely sort of following the stock. Energy Transportation, some of the others are doing better. Do you like Pembina?
We don't have it in the portfolio. I think the macro environment is tough for energy and energy infrastructure type of names and pipeline names like Pembina. You could tell by the stock prices really being just sort of a sideways, up and down type of move. The 200-day moving average is starting to trend a little bit lower, which is not a fantastic sign. Certainly, you're getting a pretty nice yield at 5.8% today. That's going to probably remain steady going forward. But I just think that the macro environment and just the overall economic viewpoint, right or wrong, is a bit tough for energy and pipeline type of names. And the regulatory environment is not extremely helpful as well.
So regulatory, we know there's always been sort of long-standing problems trying to get things approved. But with Canada now sort of on board to the idea, the government on board to the idea of expanding energy projects, do you get any more optimism from that?
Not sure, because the stock price is not telling us that right now. I think that the market is telling us that it's a little unsure of that at this point and doubtful of what actually gets done. Really, the stock has not reflected that at all, that optimism.
Got it. Okay, let's go back to the phone lines. We have John on the line from London, Ontario. Hi, John.
Hi, Marilla. Hello, Stan. Stan, 6 of the 7 Mag 7 have reported. Microsoft and Meta led the way. Google did well. Amazon pulled back and is recovering. NVIDIA is later this month. Do you see one or two names in the Mag 7 that you favor over the others? I own them all. I want to add to maybe one or two for the next 2 to 5 years. Thank you.
Okay, thank you for the question. I always find that a hard question because they're all considered sort of top performers,
Sure.
but they run very different businesses when it comes down to it.
Yes, and I would say that Tesla would be a little bit of a different animal, just given its extreme or more extreme valuation relative to the other 6 names. I can tell you that in our portfolio, we like Apple, or it's in the portfolio. We have Apple, we have Alphabet, we have Amazon, we have NVIDIA. So those are the names that we favor. Meta tracks well or shows up well on our radar. We just don't own it because we can't have 90% of our portfolio in tech and Mag 7 names. So those few names I like. I would say that just, Tesla is a bit expensive. I have some concerns over, where management is going and where the attention of management is at any given moment, and also the valuations of Tesla. So out of those several names, I'd say Tesla is a little bit of a different animal. And Microsoft, to me, has always seemed a bit expensive. as well compared to some of the other names.
Okay, just wondering about Apple. There were concerns from investors that it didn't have an AI strategy moving forward, and that was weighing on the company. Do you have those concerns at all?
AI is an important piece, but it's not the only piece for companies like Apple. I mean, they've got cash flow and they've got cash reserves that are the size of many economies combined. So I think the strength in the balance sheet of Apple speaks for itself. Some of the latest developments this week with Apple is conducive to higher returns going forward, or the stock price moving higher as well. Some of the concessions that have been made in terms of, not all the iPhones may need to be made in the U.S. I don't think that's possible, but there's investments being made in the U.S. So I think that from a government perspective, they're looking a little bit more favorably towards Apple and not looking to punish them.
To ding them the way they were. It sounds like the Apple investments are going to be through their partnerships almost, not like they're going to bring Apple production back to the U.S.,
No.
but certain components that are already built in the U.S., they'll invest in those partnerships more.
Yeah, so more investment into the country, which is what President Trump wants to see. And, I noticed today that Apple's broken above the 200-day moving average, which is one strong or one positive technical signal.
Got it. All right, we are going to take a quick break, lining up more phone calls for Stan Wong. He's taking your questions on North American large caps and ETFs. Here's how to reach us. We're back in just a moment. Stay tuned. Welcome back, and thanks for joining us. Let's go to the phone lines. Terry has been holding. He's in Edmonton. Hi, Terry.
Good day, Don. I missed this XEI, and I'd like to get into it. Do you think I should wait for a pullback or buy it now? Thank you very much.
Okay, thank you for the question. XEI at about $29, just short of that. What is it comprised of?
Thanks, Terry, for the question. So this is basically a basket of Canadian higher dividend-paying stocks. The largest weighting in this ETF would be banks at about 24%. Then you've got oil and gas and pipelines combined at about 30%. So some of the holdings would be, TD Bank, Royal Bank, Enbridge, and so forth. You're getting about a 3.9% dividend yield. 4.6%. Percent dividend yield today. We do own this in our ETF strategies. We like it. I think that getting these dividends in a stable or falling interest rate environment makes sense. So, when interest rates are moving higher, you want dividend appreciation. When interest rates are moving lower or stable, then it's okay to have, absolute dividend type of names. I think at this stage, when you're buying a dividend strategy, you don't need to necessarily wait for a better entry point. It's not overbought right now. I'm looking at a 52 RSI, because if you wait, then you're missing out on the dividend in the time that you're waiting. Unlike buying a Google or another name like that, or Amazon that doesn't have a dividend, then you're not missing out if you're waiting to buy a dip here. You're going to miss out on the dividend if you're waiting too long, especially if it's not really overbought. So I like this name. With that being said, September is a bit of a weaker month for equity markets, as you may know. If you look at the S&P 500, for example, in the last 10 years, the average return for September is almost negative 2%, and 6 out of 10 years have been negative. So, maybe there is some weakness in September. I actually don't know, how the TSX fares off the top of my head, but I will.
So it might be a better time if he wants to dip in to wait a few weeks.
Yeah, it could be. Again, you're missing on a dividend at that stage.
Got it. Okay. Let's move on then to Elliot, who's calling from Hamilton, Ontario, with a question. Hi, Elliot.
Good afternoon. This coming hookup between the credit card company Capital One Financial and the global transactions platform Discover, I think is going to be a superb growth and synergies engine. What do you and the technicals think? Thank you.
Okay. Thank you for the question. Capital One and Discover.
Yes, I mean, that's something that had been anticipated for a while, more consolidation in that space to go up against names like MasterCard and Visa. So I think that name has registered well. With that being said, in our portfolios right now, we have Visa, MasterCard, and American Express in that similar space. Shares are trading at about sorry.
For Capital One specifically?
Yeah, Capital One is trading about
208, almost 209?
Yeah, and a 12 times forward PE with a decent growth rate. So I can't say anything wrong about the name. I like the name. It's just it's not our focus right now. We'll talk about another global payments company name in top picks. But from a technical perspective, I see a pattern of since late 2022, a series of higher highs and higher lows. So ascending move higher, and shares are above a trending higher 200-day moving average.
Got it. Okay, let's go back to the phone lines. Michelle is on the line from Vancouver with her question. Hi, Michelle.
Hi, Morella. Can I get Dan's analysis on United Health? Where do you see the stock going long term? Should I keep on holding, and would it be a good time to buy more? Thanks for taking my question. Okay,
thank you for the question. United Health, which we've talked about for a few months now because it's been depressed. It's been hit by a number of different things. It is down to 248, 250, so it's a little bit up today, 2.3%. But over the year, down 55%. I know they're a big player in the U.S., if not the biggest in the insurance.
Yeah.
Is it able to pick itself up from the many things that have dragged it down? Because it's not just one big hit.
The dark cloud is this concern about overstated revenues and also what the regulatory environment is looking at right now. That's the overriding concern. So we don't have it in our portfolio. I would suggest as an investor, if you want to buy into something in which you can look like a hero a year later, then I would take a small percentage and perhaps own this name. With that being said, I see earnings growth being rather negative over the next few years, even though the stock is cheap on a PE level. Earnings growth looks to be negative over the next few years based on what I'm seeing here. I do know that, in the past week, we've seen reports of hedge fund companies getting into United Health and buying that, which is a positive thing at this point. Very, very oversold. You are taking on some risk in case something blows up with this. I don't really see a basing pattern just yet. We need a little bit more from that based on the charts. It's really been down at these levels since May and then moved up a little bit and now back down to these levels. But I would only advise if you're looking to own a small percentage of your portfolio.
Yeah, it could take some time to come back.
Absolutely.
Got it. Okay, let's go to Mark. Mark's on the line from Milton, Ontario. Hi, Mark. Did we lose Mark? Mark, are you still there? Okay, I'm going to move on to Reg, calling from Winnipeg with a question. Hi, Reg.
Oh, thanks for taking my call. So, Stan, here's a question for you. This is on Manulife Financial. So they reported a couple of days ago, reported $1.8 billion. Stan, help me on the math on this. So it doesn't get a lot of coverage like the banks does, but it's got a 4.4% dividend. Its cash to pay this dividend is about 50% of their cash flow to pay their dividend. Biggest footprint in Asia. Stock, it seems like whatever they report is irrelevant. It doesn't move. The financials own 55% of the float of this stock, and it seems like it's just a casino thing. They just, short the stock between themselves. Why doesn't it get any traction? If you line it up between Sun Life and Great-West Life, it's way, way cheaper. It makes no sense why it's trading at $41 today. Can you answer that? Thank you.
Okay, so why isn't it getting traction? Any obvious reason for that?
I mean, certainly the stock has been stuck at these levels and moving flat over the last little while. I think there was a report yesterday that there was a downgrade on Manulife, if I recall. I could be wrong on this one, but I thought I saw that report come through yesterday. I think the stock is undervalued at this point. We actually do own in our portfolio. As the caller said, you're getting a great dividend yield, and it's a steady growth type of company. I see about 8% growth going forward into the next few years. You're looking at a price-to-book ratio of 1.6 times, which is, I think fairly cheap relative to some of its peers. It's got a bit of a wait-and-see type of thing, but clearly the market has been hesitant to really push it to new heights, as it has with other financials names. But I can see the 200-day moving average, as you sort of draw out a little bit and forget about the last few months. The 200-day moving average is still trending higher, although, flattening a little bit, still trending higher. And the stock price is below that now, but nothing of major concern because it's fallen below that and moved back up again. So, you get paid while you wait, which is very important. And I think the dividend yield will remain very, very steady and upward moving.
Got it. Okay, we're going to take a quick break. When we come back, we'll have a look at Stan's past picks. We're back in a moment. Welcome back. Time to go through Stan's top picks from September 24th of 2024. At the time, he chose Alphabet, of course, parent company of Google. It was 162.29 US at the time, now up to 199.29 today. So 23% return, 23% total return. I know you mentioned you have a few of the techs. Apple is one of the ones you favor. What did you like about Alphabet? What do you continue to like about Alphabet? There were concerns about search, right?
Sure, yeah. I mean, overall in our portfolio, a few themes kind of resonate. Number one, I really like companies that operate in industries where there is really not a lot of meaningful competition. And I think Alphabet is clearly, or Google's clearly in that space. And number two, I like companies with good earnings growth. And again, Alphabet is in that space with about a 13 to 15% earnings growth rate going forward. You're paying 20 times forward PE, not expensive. I think AI and cloud momentum is very, very key for Alphabet moving forward, with those items sort of contributing to revenue very meaningfully. Their advertising platform continues to be the monster out there. And as macro conditions improve and ad budgets continue to improve, I think Alphabet and Google will really perform well with that. And that, of course, they've got a massive cash position, maybe not quite as big as Apple. That can lead to very aggressive share repurchases, which will move the price higher and help with EPS and so forth. And really, I think that some of that cash provides downside resilience in tough times in the markets.
Got it. Okay, let's get to your second pick from September of last year. A Dollarama on the TSX, 136.14 at the time. Now up to 192.47, so 41% upside for return and 42% for total return. Dollarama, we talked about initially when tariffs were first announced, and there was the sentiment that consumers would go to Dollarama and other stores because they want to save their money. They were worried about the economy. Is Dollarama still, in the past few months, doing as well? Because people have sort of come back, sentiment has come back, they're not as worried.
Well, I mean, Dollarama is benefiting from many different avenues. Number one, you look at their traffic and basket sizes, they remain very robust because there is a bit of a trade down behavior given, very sticky inflation over the years, even though inflation is low now, but over the years, cumulative inflation has been high. So there's been a trade down in the economy, in consumers over to a place like Dollarama. Secondly, we see a little bit of softness in the Canadian economy in the second quarter and third quarter of this year, which can benefit Dollarama as well. So I think that those two things are helping a name like Dollarama. Certainly, you're paying a premium for Dollarama. It's at over 40 times forward PE. You are getting a 15% growth rate. But again, Dollarama meets that parameter of being in an industry whereby, at least in Canada, there's very little competition in this dollar store merchant space. And also earnings growth is in decent double digits, which meets our criteria as well. So very strong financial strength. You're seeing very good margin expansion over time, strong free cash flow. They're aggressively growing their store count in Canada and also Latin America as well. I see, dividend growth going forward down the line and share repurchases, given this strong free cash flow.
Got it. Let's get to your third pick then. Eli Lilly on the New York Stock Exchange at the time at 924.43 US, down to 630.85, so 32% drop return, 31% total return drop. Eli Lilly, a lot of the pharma care space has been under a lot of pressure. It feels like no one's come out with the next big thing to lift the sector up. Would you still invest in Eli Lilly today? A
lot of this move happened this week, as you can see on the chart. their numbers are good. Their earnings and revenue beat expectations. Their guidance was good. The market really honed in on the obesity pill drug disappointment, in that there was a little less efficacy than a competitor's efficacy, just by a couple percentage points. And then also 10% of the people that were trialing this were dropping out because of side effects, which is a little higher than the market expected. But again, this really overshadowed all their other numbers, being the Q2 results and also raising guidance. So I think from a valuation perspective, Eli Lilly is trading at now 24 times PE with a 19% growth rate expected. So I think it's very cheap, but sentiment has become very difficult and challenged in this space. You look at a stock like Novo Nordisk compared to this, it's been very tough. With that being said, the diabetes market and the demand for obesity drugs long term is still there. That's going to continue to grow, and they'll continue to have drugs that will evolve and meet this demand over time. So short term, there's some sentiment risk. I think long term, a name like Eli Lilly makes a lot of sense. And it's not just about diabetes drugs and obesity management drugs. They've got a really great Alzheimer's drug that's industry leading, that's in the pipeline as well. So Eli Lilly, to me, has always had great cash flow. It's got a really fortress-like balance sheet. So continue to like that name, but short term, there seems to be a bit of pain around it.
Got it. Okay, we're going to take a quick break, lining up some more phone calls for Stan. And when we come back, he'll take your questions. Stay tuned. Welcome back to Market Call. Thanks for joining us. We're going to take an email from Mark, who says, can I get your thoughts on DraftKings? DraftKings, is that one you follow?
I know the name. We don't own in the portfolio. It's, fantasy sports and sports betting company, online sports betting, which has really grown, as you know, in North America. And I think it will continue to grow. We see a pretty explosive growth rate for a lot of these names, including DraftKings. You're paying about 41 times forward earnings at this point, but the growth rate is very high, 30, okay. 40, 50%, depending on what you're looking at.
Wow.
So we do see some very, very strong growth. With that being said, this is a high beta name. You're looking at about well over 1.5 times the beta of the S&P 500, so it's volatile. So depending on your risk tolerance and your time horizon, probably want to make it a smaller position in your portfolio. It's not going to be necessarily a core position in your portfolio. Again, we don't own it. The 200-day has been kind of inching sideways a little bit, slightly upwards more recently. Stock price is above there, but technically it's not really telling us one thing or the other. At this point, it's been rather neutral. But from a fundamental quantitative approach, we see a lot of growth in this particular space.
Got it. Okay, let's go back to the phone lines. Bob is on the line in Toronto. Hi, Bob.
Hi, Marilla. Thanks for taking my call. Stan, a lot of the pundits seem to think that CNQ is an undervalued stock at the present time. I'm just wondering what your thoughts are on it. Thank you.
Okay, CNQ does get recommended a lot by some who come through. They say it's a stable company. What are your thoughts on CNQ? I would put CNQ and Suncor as kind of your core Canadian energy names. With that being said, the energy space has been very tough. Prices have been low. OPEC is, producing more than we expect and so forth. So right now we don't have exposures to those particular energy names. And of course, the regulatory environment, which you spoke about earlier, is tough in Canada for some of these names. So it's not a name that we have. You're getting obviously a great dividend yield at 5.66 right now, as you are with some of the other large cap Canadian dividend names. But I think just from the perspective of the macro environment, or at least what the global economy is feeling and thinking, I'm not in this energy space right now. Dividend yield should remain pretty steady. So if you're looking for dividend yield, I think it's there.
but I just worry about pricing right now, and the technicals do not look great on a lot of these energy names, and that's why we're out of them right now. The 200-day is falling. It's slightly below, the price is below the 200-day moving average, so not a strong technical signal right now.
Okay, so price of oil, can you just generally weigh in? We know it's a little bit better than it was sort of the start of the year in the spring, but are you expecting it to continue to hold, or do you think it might sort of waffle a little bit more? You mentioned OPEC plus.
Yeah.
One factor, Russian oil might be tariffed again as well.
Yeah, we're looking at $64 WTI right now, and it's just slowly moving down. If you look at the 200-day moving average for oil prices, hard to predict because in terms of what we forecast for oil prices, so much of it depends on OPEC plus and what they do or don't do. I would just say that the sentiment around the economy is still a bit uncertain. Global economy is a bit uncertain. That's why oil prices have not really, pushed higher at this point.
Got it. Okay, let's go to Anne. She's on the line from Scarborough, Ontario. Hi, Anne.
Hi. Stan, I recently bought shares in Cameco. Do you think this company has a long runway? Thank you.
Okay, thank you for the question. Cameco is benefiting from a push in uranium and nuclear.
Yeah, absolutely. And also you add into that cryptocurrency mining and so forth. You need this power. So we do like Cameco long term. I think that this entire space will make sense long term, clean energy from nuclear power. Valuations are a bit extended at this point, and just from technically speaking, it's kind of pushed up into a different stratosphere. So if it happens, I'd probably look at buying it at a slightly lower price, between the 80s and 90s. If it happens, it may not happen. But I like the technical structure. It's a name that we've kind of been watching and kind of wishing we bought that a little bit earlier. But I do like the nuclear space. I think long term, it makes a lot of sense. Clean energy is going to be with us for a long time, or the need for clean energy will be there.
All right, let's get to one more call before we have to take a break. Robert is on the line from Scarborough with a question as well. Hi, Robert.
Oh, hi. Thanks for taking my call. I'm thinking of buying either CN Rail or CP Rail. They're both solid companies, but because of the forest fires and tariffs, their stock prices have been coming down lately. So if you had to choose one, which one would it be, and when would you buy it?
Okay, so here's our comparison on the charts. CN Rail in the blue, CP Kansas City, as it is known in the orange color, doing better than CN Rail. Would you go CP?
So thanks for the call, Robert. I would suggest that, well, first I'd say we don't own either. It's not a space in which I really favor right now, based on what we talked at the top of the show being we're seeing some softness in the Canadian economy. And yes, CPKC has a bit more exposure to the US, of course, but of course it still has exposure to Canada. I just think that right now, being sort of mid-cycle at this point, industrial names like railways, you might be a little bit late being in that space. Maybe look at some of the US names, but with that being said, I haven't really looked at some of the US rails at this point. But if I were to choose, if I were forced to choose between one or the other, I like the technical makeup of CPKC right now, and I like the fact that it has a bit more scale than CNR.
Got it. Okay. Hope that helps you out, Robert. Let's move on to another caller, Alan from Montreal. Hi, Alan. Alan, are you still there? Okay, we may have lost him, so we are going to take a quick break. Back with more of your phone calls and your emails for Stan Wong in a moment. He's taking your questions today on North American large caps and ETFs. Stay tuned for that. Welcome back. Thanks for joining us. Let's go to a call from Alan on the line. We've reconnected with him. He's in Montreal. Hi, Alan.
Hi, I'm here.
Go ahead.
Okay. I'd like to ask Stan his opinion of the ETF VDY.
Okay, thank you for the question. Let's have a look at VDY. What is comprised, or what does it have in the basket?
Yeah, so VDY is a high dividend yield index ETF, similar to XEI, the iShares version we spoke about a little while ago in the show. The only difference I would say about this one is that unlike XEI, which is about 24% banks, this is 45% banks. So if you really like Canadian banks, then VDY might be the one for you. But if you want to be a bit more diversified, which I think you want to be, XCI might be a little bit better. It certainly performed well. VDY has done very, very well. The past 5 years, it's returned nearly 17% on average per year. You're getting a 3.6% dividend yield as well. But again, I would caution that it is heavy into banks, and I'm not making an opinion on Canadian banks one way or the other. It's just you're going to own a lot of banks by owning this particular ETF.
Got it. So if you're comfortable with that, then yeah, go ahead. All right, let's go to Jerry. He's in Vancouver. Hi, Jerry.
Hi. Thanks for taking that call. Stan, the majority of my portfolio is steady Eddie stocks that pay good fat dividends, but a portion of my portfolio is I like buying stocks on the dips. IBM has caught my eye. Do you see value there, or are there some snakes in the woods there that I don't see? Your thoughts. Thank you.
Thank you for the question. What's IBM been doing lately? They used to be the name, and then they lost traction.
Yeah, I mean, it kind of got out of the really exciting parts of technology, and they're starting to get back into that space somewhat. But with that being said, IBM is a name that we haven't held in the portfolio simply because it doesn't meet what we want to see in an EPS growth type of environment. We're seeing about 6 or 7% earnings growth forecast for IBM. So right there, it doesn't really meet what we're looking for, particularly in the technology space, because when you're in the technology space, you want to see 10, 15, 20% earnings growth. The stock, interestingly, has performed decently in terms of trend lines. It has been moving higher, but it's moved down to the 200-day moving average, which could present a buying opportunity. But for us, I'd like to be in a name that has a bit more earnings growth involved, particularly if I'm selecting a name in the tech space. So technically, from a charting perspective, it's not bad. Fundamentally or quantitatively, you're paying 21 times for a 6-7% grower. Probably not a name that will fall in our portfolio.
Got it. Okay, let's go to Mark. He is on the line in Winnipeg. Hi, Mark.
Hi, Stan. Thank you for taking my call. What's your opinion on Sun Life? It's down over 7% today. And is it a good time for me to maybe start to nibble in, or?
Okay, thank you for the question. It's at 78.18, down more than 7.5%. I didn't see any reason for that, but let me have another look here. Overall, what is your take on Sun Life?
Yeah, it looks like Sun Life beat EPS estimates today, but I'm not sure, exactly what's behind the drop today. Although, Manulife had a weekday today as well. This week so far. I mean, I think with Sun Life, you're getting a high quality company, no doubt. And long term, its exposure to Asia, its exposure to the aging demographic and the need for financial services makes a lot of sense from a secular growth perspective. I think there was a couple of downgrades now that I'm seeing what's happening with the stock price, but I still think that it's a very good long-term growth company. You're paying about 10 times forward earnings, which is nothing too bad at this point, and you're getting a 4.5% dividend yield, which is nice, I think, in a falling interest rate environment. So there could be an opportunity for those who don't own Sun Life or some of these other insurance names to own them, because when we look at the growth of the dividend yield, projected growth, it's expected to grow by 8 or 9% a year in terms of the dividend yield growth.
Yeah, you mentioned they're doing well in Asia, but underlying earnings from individual protection, that part of the business, is down 10%. So that could be something people are paying attention to. Okay, thank you for that question. Let's go on to Devish, who's from Calgary today. What's your question?
Good afternoon. Thank you for taking my call. My question is, what is Guest's thought on diversifying, going through HXX ETF, which is a Global X Europe 50 Index corporate class ETF, swap-based exposure?
Okay, thank you for the question. Let's just pull it up here. Horizons Euro. Do you know this one well?
Yeah, so this is basically a Canadian ETF that is based on the Euro Stocks 50 index, which is the 50 largest companies in Europe. So you're just getting that exposure for about 19 basis points. I think that Europe makes a lot of sense. You'll notice that international markets are starting to perform well relative to the U.S., given U.S. policy uncertainty, given the fact that we've seen a lot of valuations move higher on a relative basis in the U.S. relative to Europe. So I think that having some exposure and pushing exposure from the U.S. and North America into Europe makes some sense. The top names in Europe in the the Eurostoxx 50 index would be SAP, software company, ASML, Siemens, Allianz, which is financial services company. It makes sense to go into that space just because there is a discount, and that discount has grown quite a bit between Europe and the U.S. So from a valuation perspective, we have been moving some names, some of our exposure into Europe.
Got it. Okay, let's get to one more phone call. Bally's in the line from Toronto. Hi, Bally.
Hey, Stan. Thanks for taking my question. Appreciate it. My question is largely, I've been seeing, Qualcomm and Taiwan Semiconductor, and there is this tariff thing, from Trump. But overall, one opposed to the other, while Qualcomm has also recently approached Intel for a takeover versus TSMC, which happens to do a large part of manufacturing. What would be your guidance? Is that a buy? Are they the right bullish investments? And is TSMC the right pick? And where do you see it going?
Okay, thank you for the question. Taiwan Semiconductor, so much going on in the space, right? 100% tariff is what Donald Trump wants to slap on chips that are not made in the U.S., and he's talking about ratcheting that up sort of in a year. But what is your take on Taiwan?
For now, that's what the tariff.
Sure, and we know by Friday night it could be a totally different scenario.
Yeah, and that's the difficulty of using those pieces of news and data to try and formulate an investment opinion because it can change so quickly, and we've seen it change very, very quickly. TSM is a name that's on our short list, not in the portfolio, but it's on our short list. I think this name makes a lot of sense. You're looking at a name that's one of the biggest chip companies in the world, with a 22% growth rate forecasted going forward. The only thing is that from a pricing perspective, it's just a little bit up there. It's overbought at this point. We want to see it come down a little bit into the low 200s if we can, and we'll look to buy it at that point. So I think it makes sense, and it also feeds into the idea of sort of going a little bit more global and international and away from being too U.S.-centric. Again, U.S. policy uncertainty and valuations are stretched in the U.S. to a certain degree.
Got it. Okay, we're going to take a quick break. When we come back, Stan will share his new top picks. Back in a moment. Join us Monday for Market Call. John Stevenson on the show, President and CEO Stevenson and Company. He'll take your questions on North American large caps and resource stocks. Time now for Stan Wong's new top picks. And at the top of his list is Netflix, which we just looked up, has been moving down sort of over the past month. But this is a company you support.
Yeah, I think if you go back 2 or 3 years and you started thinking, well, who's going to be the leader in the subscription video streaming market, we know today who it is, and that's Netflix with over 300 million subscribers around the world. And that content library continues to grow, and they've got local content in different countries. And that's really supporting really rapid international growth. Revenue for 2026 fiscal is expected to exceed $50 billion US, again, driven by global expansion. The ad-supported tier has been very, very successful for Netflix. The crackdown on password sharing has been
very successful. Sure.
I'm feeling it myself when I sort of get stopped when I'm using it, and my kids are using it. And the price optimization has been very strong across different markets as well. So, it's a bit of a virtuous circle. Like they're getting more revenue because they're getting more local and better, interesting content, and now sports content and live events, which gives them more money to invest in more content and so on and so on. So it's really helping Netflix differentiate themselves from other streaming networks, including Disney Plus, for that matter. And their financial performance has been so strong, like revenue is accelerating, margins are expanding, cash flow has been very strong. You're paying 40 times forward earnings, but you're getting about a 27 to 30% expected growth rate out of this particular company. So
you can't argue with that.
Yeah, it's tech company, but great valuation.
All right, let's get to your next pick, which is Visa, also a favorite by many. And it has had a little bit of pressure on it, but you like Visa moving forward as well.
Yeah, again, another global leader. Very few competitors like I like in this industry. The stocks come down to the 200-day moving average, which I've always felt like is a good time to dip back into it. We've held this stock since 2016, been adding to it, been taking away when it kind of got frothy, but we've held it pretty much in 2016. We expect revenue for 2026 to exceed $44 billion. Their Visa Direct model is also going to increase revenues for them as well. They're a really consistent company, very steady growth, and that's what you get when you've got 2 or 3 players in a specific industry. You've got the ability to command pricing, command revenue, and so forth. And you're looking at about 13% to 15% compounded earnings growth going forward for this name. So the fact that it's at the 200-day moving average, for me, we bought more shares at this point for clients.
Got it. Let's get to your third pick, which is Waste Management in New York. What do you like about Waste Management?
Yeah, you know, with Waste Management, I mean, you look at the third pick, they can't be all exciting names like Netflix and Amazon and so forth and Visa. I like this name because it's important in a portfolio when you construct it to have some lower beta, more defensive names, especially when you're getting mid to late cycle. It is a leader, of course. The company and the industry has very high barriers to entry, which is important to me. We don't want, you know, another 50 competitors just show up at the door. There's only a few major competitors in this environmental services space in North America. Waste Connections is another name, which we own as well. But I think some of the secular trends like urbanization, population growth, more regulatory focus on sustainable waste solutions helps a name like Waste Management. And we see about, a steady 10 to 12% growth rate.
Got it. All right, we've got to leave it there, Stan. Thanks for coming in. Good to see you. That does it for us on Market Call. Thank you for joining us. We'll see you again on Monday.